Welcome to PIMCO Pod. In this episode, we discuss how the software sector remains challenged by pressured valuations, uncertain recoveries, and less reliable sponsor support. Stay tuned after the conclusion of the podcast for additional important information. The Credit Market Lens: Software Stuck in a Trough by Lofty Karui. The software sector remains stuck in a trough across the capital structure. Software equities saw a meaningful relief rally last week but remained down about 20% year to date, while the modest March recovery in software leveraged loans has stalled. Despite compositional differences, public equities generally represent larger companies with more scale, liquidity, and financial flexibility than the typically smaller, private equity-owned issuers that dominate the software loan market. The outcome is the same. Neither market has been able to fully retrace the year-to-date sell-off in a meaningful way. Public software equities are effectively long-duration assets. They typically pay no dividend and rely more on long-term cash flow expectations than other sectors. So the March backup in interest rates was not particularly helpful. In credit, investors have historically leaned on the sponsor put, i.e., the ability of financial sponsors to support portfolio companies via add-on capital, debt buybacks, and other liability management tools, but that backstop has been less reliable this time. The good news is that relatively benign near-term refinancing needs for software companies limit the risk of an abrupt rise in financial distress. That said, this is hardly a clean bill of health, and the fundamental challenges around terminal values are unlikely to dissipate anytime soon. An inflection in the broader business cycle would almost certainly turn latent, sector-specific vulnerabilities into higher defaults over time. If a software-led default cycle were to emerge, however, history offers limited direct guidance. The software sector as we know it today, characterized by loan-heavy capital structures and significant sponsor involvement, has not experienced a meaningful episode of financial distress. As a result, empirical evidence on default intensity and recovery behavior remains scant. That does not mean history is silent. There are precedents of industry-specific shocks driven by technological change that resulted in asset obsolescence or excess supply. The rise of the Internet and the ensuing print media defaults of the early 2000s illustrate the former, while shale production and the resulting energy sector distress exemplify the latter. These episodes suggest a common pattern. When depressed residual asset values coincide with a concentration of distressed supply, recovery rates tend to be materially lower than average. Consistent with this, recoveries during such periods, particularly in recessions, are notably lower than in low default environments. Another look at dispersion in BDC portfolios. Valuation opacity in corporate direct lending portfolios remains front and center. Investors increasingly recognize that the smoother return profile over the past decade for this subset of private markets largely reflects lower observed volatility, not inherently lower risk. What is less appreciated is the extent to which opaque valuation practices and stale price marks have distorted the cross-sectional distribution of loan prices within BDC portfolios. These practices have artificially compressed dispersion and created an appearance of stability that is not fully consistent with underlying credit diversity. This stands in sharp contrast to the broadly syndicated loan market, where continuous price discovery produces a wider, more informative range of outcomes across outstanding loans. Two metrics underscore this gap. First, for loans held across multiple BDCs, the spread between the most conservative and most optimistic marks has widened meaningfully in recent quarters. This divergence signals growing uncertainty around true valuations and has contributed to recent redemption pressures. Second, since 2021, the overall price dispersion within BDC portfolios has been an order of magnitude lower than in the broadly syndicated loan market, leading to an implausibly tight range given broadly comparable credit risk. In a stress scenario in which marks are forced to converge toward realizable value, dispersion would likely widen abruptly. Taken together, the software credit landscape looks stable on the surface, but more fragile underneath. This argues for selectivity, a focus on downside mitigation, and caution towards strategies that rely on smooth reported valuations rather than resilient fundamentals. Thank you for listening. That was The Credit Market Lens: Software Stuck in a Trough. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.